Good morning, everyone, and welcome to today's webinar on loan options for self-employed borrowers. Now, this webinar is being recorded, and as questions come up, go ahead and ask them as they occur to you. We want this to be as interactive and engaging for you as possible, so please go ahead and ask the questions, and I will ask the speakers on your behalf. With that, I'll go ahead and turn it over to today's speakers. Take it away.
Hi, everyone.
Good morning, everybody, or afternoon, depending where you're located. I'll start off by introducing myself. My name is Christian Drews. I'm a regional manager here with LendSure, located in Salt Lake City, Utah. I've been with LendSure for about 4 years.
My name is Andrew Wiseman. I'm currently a credit analyst in the San Diego office, and I've been with the company a little over a year now.
My name is Jordan Farhat. I'm an account executive. I've been with the company coming up on 5 years now, I think. I was an underwriter for 2 years and then transitioned into sales for the last 3 years.
Perfect. All right, before we get going, just go over the agenda for today. So first, we'll give you guys a little backstory on who LendSure is. Followed by that, Jordan will tell us a little bit about what we do and more specifically, maybe what we don't do. From there, we'll get into the meat and potatoes of today's meeting, which is our bank statement program. We'll provide some real life loan scenarios that we've come across to give you guys some examples. We'll do a deep dive into some of our guidelines around our bank statement program, what sets us apart from our competitors and their bank statement programs. And we'll end with a little bit of Q&A. So again, as Rose said, as questions come up, please type them in the chat and we'll be sure to answer all those at the end. Next slide. So just real briefly on who LendSure is, if you're unfamiliar with us. So we've been around for about 9 years now, securitizing loans since 2015. We are headquartered in San Diego, California. We do have a pretty solid national presence, however, with offices in Rhode Island, Atlanta, Georgia, Salt Lake City, Utah, as well as Missouri. We do have a highly experienced management team here, which is one of the main benefits to us. So as mentioned, LendSure itself has been around since 2015, but our entire senior management team was formerly with a company known as Accredited Home Lenders, doing loans since the early 90s into the mid 2000s. So again, lots of experience here, very good at doing loans, very good in the non-QM space. And we are currently licensed in all 50 states, the only real outlier being New York, in which we are only currently doing investment properties only. Every other state, we're good to go with owner-occupied second homes or investments.
Next slide, Rose. All right, with this one.
I'm sorry, I was just going to say that there's a tiny lag in by the time I click it, so just give it a second for the next slide.
Got it. With this one, I like to kind of start with what we don't do first. So we don't do any, Fannie Freddie, conventional FHA or VA programs. Our primary focus is the people that typically just miss the A-paper programs. So right on the edges of conforming. We have a bridge loan with no monthly payments. We do determine ATR differently than, the agency programs. We have expanded interest-only options, 10-year fixed and a 5-year fixed. We have DSCR options, the typical non-QM programs that you hear about for 1 to 4 units, 5 to 8 units, non-warrantable condos, condo tells. Our bread and butter is typically our bridge loan and our bank statements right now. So we'll dive into these programs later and you'd ask the questions as you feel needed.
Jordan, just to interject real fast, to Jordan's point, guys, we don't do any of the government-backed loans, right? And so what that means is we are truly looking to partner with you. One thing that we do like to do quite a bit is to pair up with presentations with you guys for your realtors or your financial advisors, whatever it may be. So again, keep that in mind throughout the presentation. That if you find this valuable, we would love to schedule things to do a co-presentation or event with your referral partners.
Good point. Yep. And next, we're talking about the market opportunity. So in 2023, they did a study. 10.1% of the workforce is currently self-employed. Now, that seems like a small number, but when you think about, all the different programs we use nowadays, getting groceries delivered to our homes, food delivered to our homes, Amazon packages coming nonstop. there are a lot of different people that fall into that freelancer or self-employed, even if it's just a side gig, kind of position for them. And we do have the opportunity to use that extra income to help qualify for loans. So just think about all the different out of the box, things that we use every day that we forget, like, hey, maybe this guy can't qualify for the normal loan. These are great options for those kind of borrowers. Yep, and then borrower profiles, we'll talk more about this in detail, but just to give you guys an idea, help you think about what kind of people we're targeting with these programs. Bank statement income with asset depletion, so someone that has lots of assets and also self-employed. W-2 borrower whose spouse is self-employed. We can combine both forms of income. It does not have to be only bank statement or only full doc. We can do both. We'll touch deeply on this one later, but same line of work for 10 years, but became self-employed for just 1 year, whether that's transition to a 1099 position or something in that realm. We'll talk more on that later. Combining personal and business income, an owner of multiple businesses where we're talking 3-4 different bank accounts, stuff like that, totally different expense factors, and then hybrid income, which Andrew will touch on later as well.
Yeah, thanks, Jordan. And that's a great point. As we go through the presentation later, we will be talking about our Spark pricing engine, which is a great resource for all of you guys to have. But on that note of the multiple ways that we can combine income sources, we want to make sure that you're calling your account executive with LendSure. All of us have underwriting experience. We want to make sure that we talk about the loan over the phone, discuss the roadblocks in the way, and typically we're able to find a way to maybe get creative and structure income uniquely. So, but okay, diving into bank statements. So as Jordan mentioned, the number of self-employed borrowers is growing exponentially here in the U.S. Our bank statement program has been a very important tool to the loan officers that we do a lot of business with. It's a great program to have in your back pocket, because I guarantee a lot of you guys now are on this webinar for a reason. You're coming across a lot of self-employed borrowers. While some self-employed borrowers do self-prepare their own taxes, I would think it's safe to say that the majority do outsource that to a professional. They outsource it to a CPA. What makes a good CPA, in my opinion, I would say typically it's a CPA that can save me money, right? It's a CPA that can help me write off as much as I can so I can limit the amount of money that I'm paying the IRS. When we look back, 3 years ago, when rates were in the mid 2s and 3%, a lot of these same self-employed borrowers were able to, still take advantage of writing off as many business expenses as they could, and they could still qualify for the home they wanted with as low as rates were. Obviously, we are unfortunately not in those that same rate environment, and so a lot of the self-employed borrowers that we have come across are now faced with the decision of, hey, do I go back and amend my taxes and qualify for that conforming rate? Or do I continue to, work my CPA and take advantage of all these tax breaks and save money that way? What's interesting is what we found is that the majority of these borrowers are actually still saving more money by continuing to write off as much as they can and take in the slightly higher non-QM rate. Just as a ballpark for you guys, I think it's important to know that as a non-QM lender, our pricing is typically 100 basis points higher than conforming, maybe 150 basis points on the high end. But again, bottom line is when you're looking at what is the net benefit to the borrower, a lot of times it makes way more sense for these guys to go with the higher non-QM rate. Now, talking about the bank statement loan, obviously the focus is going to be on, that typical business owner that you see, the owner of that family dental practice, of the auto store, whatever it is. But keep in mind that again, we can get creative with the type of borrowers that are utilizing this program. If you're looking for the low-hanging fruit, think about your realtors. All your realtors are 1099. Have you asked them what they're looking to do with their own personal loans? The bank statement program has been great for them. It's great for 1099 workers that technically don't own their own business, but they fall under that self-employed category. Along that line, we'll talk more in depth here in a little bit, but those borrowers that come across your desk that have less than 2 years or less than 1 year of self-employment history, that's probably my favorite loan that we do as we get very creative with it, but we do utilize the bank statement program to help illustrate that year-to-date income for those borrowers. And then also for those of you who are in areas where you see a lot of tip borrowers or tipped employees that make the majority of their earnings via tip, the bank statement program can be great for them as well. So quick side note as well, if you're looking for additional referral partners, I think a great underutilized area for referrals is the CPA channel. I don't know if you guys have thought about reaching out to CPAs, but in my experience and also my past life, my past career, I worked a lot with CPAs and I found a lot of business through them. So again, let's think about the types of people that are working with these self-employed borrowers and helping them write off taxes. So food for thought there. But at the end of the day, the bank statement loan and really all the programs that we offer here at LendSure are really just more tools in your arsenal to help you say yes to more borrowers that come across your desk.
And one of the things that you guys are going to be receiving after this webinar is a marketing kit with templates, email templates, flyers, social media banners, so that you can start reaching out to CPAs and other referral sources right away. Just look for an email from me, Rose Waldy, about an hour after the webinar ends, and that'll have a link to those resources for you. And Jason, yes, I will be providing a copy of the slide deck as well.
Perfect. All right, so let's dive a little bit deeper into our bank statement program and some of the things that differentiate LendSure from some of the other non-QM lenders that also offer this program. First and foremost, one of the most common requests that we get, especially for those of you that are newer to the non-QM arena, is, hey, Christian, can I send you over the bank statements and before getting a whole file over, can we figure out if we have income we can even use, right? And so that's something that we're doing all the time. Calculating the actual income for the bank statement loan is not something that we would have you guys do. We have our own team of dedicated underwriters that are calculating the income. So, at the end of the day, if you wanted to see, hey, can I get more income out for this borrower using the bank statement route rather than going conforming, send us over the 12 or 24 months of bank statements and we'll get that popped out within a day to figure out what income we have to use. As Jordan mentioned again, or earlier, we can combine multiple income sources as well. So we have one right now where wife's W-2'd and husband is bank statement self-employed borrower, right? There's other cases where we have borrowers with Social Security pension income plus bank statement income. So again, give us a call and we'll help figure it out. We do not require CPA letters or P&Ls. The purpose in that for other lenders is to help calculate the expense factor. We make it a bit easier by not requiring another third-party condition. What we have instead, and I believe Jordan's going to talk on this more later, but we have what we call our self-employment questionnaire, which is LendSure's own internal form. It's a quick 2 pages, asks some very simple questions for the borrower to fill out, that asks about their expenses, how is income generated, how does the business operate, right? But again, easy form for the borrowers to fill out. Just one last thing that we have to require, or we have to wait on a third party for.
Christian, I'm sorry, Teresa wants to know what determines whether it's 12 months or 24 months of bank statements. That's a great question.
Yeah, great question. So depending on the LTV ask, that could determine it. But ultimately, what we always recommend is we would always like to start with 24 months to begin with if we can. If for some reason the previous 12 months is hurting our overall average, we'll take out the previous 12 and call it a 12-month bank statement deal. But we are actually incentivizing 24-month bank statement deals right now to the point where 24-month bank statements with LendSure actually price is better than going full doc, right? And a quick side note to that as well, we prefer to go the bank statement route over going self-employed full doc because again, number one, we're able to get more income out typically. But number two, one of the conditions that I'm sure has driven you guys all crazy before, it's driven us crazy, is ordering transcripts or getting a 4506 and ordering transcripts from the IRS. Again, the least amount of conditions we can worry about that are third-party related, especially IRS-related conditions, the faster we're going to move, which is a big reason we're able to have such great turn times. But again, 24 months does price better than 12, also provides higher LTVs, okay?
And Albert wants to know, do you use the same expense factor for every business or is it based on the industry?
I can take this one.
Another great question. So you want to take this one, Jordan? Go ahead.
I'll take it. Yeah, so at LendSure, one of the unique things about our bank statement program is we tailor our expense factor to each borrower, not to each industry, not to each program or whatever. It's to each borrower. That self-employment questionnaire allows the borrower to tell us what their expenses are. How do they run their business? How many employees do they have? Every construction company doesn't have 55 employees with thousands of dollars in payroll expenses. Some of them are smaller operations. So that form allows us to basically just lock into what does their business take to run each month, and allows us to tailor our expense factor to them personally.
Thank you.
Yep. And so if we skip down a few bullet points, right towards the middle, I guess, where it says variable expense ratios. So case by case, as Jordan mentioned. But again, if we take somebody like your realtors, a lot of our competitors use a fixed expense factor of 50%, whereas with somebody, or if we have a borrower like a realtor, we're going to use our minimum of 10%, right? They have very limited expenses, maybe some marketing. The bottom line is for borrowers like that, we're going to qualify them with much more income. But at the end of the day, as Jordan mentioned, we're going to give them a fair expense factor based on their actual expenses of that business. Okay. Last few bullet points here. Another big key, a borrower does not need to be 100% owner of the business. And I'm going to combine this actually with the next bullet point too, because I have an example of this. Multiple business bank accounts accepted. We're currently doing a loan where we have a borrower that has 4 different businesses and varying ownership percentage in each entity, anywhere from 30% up to 75%. We end up qualifying this loan, giving him his fair portion based on ownership percentage of the income, and qualified that using 4 sets of different bank accounts. So again, that's a key thing that we do quite a bit here to get the most income as possible. And then just to finish the slide off real fast, on owner-occupied properties, primary residence transactions, that is, to be more precise, we can go up to 90% LTV with 740 FICO. And then, again, 12 or 24-month bank statement options, regardless if it's a owner-occ transaction or a investment property transaction.
When evaluating our bank statement income, all owners set up their bank accounts different. So bottom line is LendSure is a common sense lender. And, based on our underwriting experience and, experience with dealing with these realtors, self-employed, Uber drivers, general counsel, lawyers, whatever the situation may be, we take an individualized approach while at the same time looking back and saying, what kind of business do these borrowers run and what are the expenses that, we may see. So when we're gaining the full picture, into a business owner's income stream, we're looking at it, again, like Jordan said, on a case-by-case basis. So we're diving into whether it be 12 or 24-month bank statements and determining what are our expenses, how is the borrower making money, and the SEQ is a huge step in determining what each business is running. So you'll see on our self-employment questionnaire, which I would assume would be attached, at the end of this meeting, we're going to ask, what type of business in it is, the borrower running for themselves. In this case, I'll walk you through maybe a construction example. So we provide details on how income is generated. And so the borrower would be able to tell us, say, hey, this is a home building construction company, and we're doing ground up construction where in this case, we have tons of outsourced subcontractors that we're paying to do work. So providing these details help us as analysts determine, how these borrowers are making money. They'd ask us, where they conduct their business, whether that be from their personal residence or if they actually rent an office space. We would ask how many people are employed. So we differentiate that into a full-time payroll, so someone you're paying to stay on your books, or maybe a contractor. In this case, the construction example would fit where you're paying people by the job. We'd ask if you manufacture a product. So do you have cost of goods sold, which goes into your business expenses? Do you buy and then resell a product? So rather than actually making it yourself, are you, maybe an auto parts dealer and dealing with buying products and reselling later for a higher price? We'll ask what percentage of the business you own. So like Christian was saying, it does not have to be 100%, but to be deemed self-employed, you do have to own 25% or more of the business. We'll ask about any additional expenses, which exclude obviously rent, payroll, cost of goods sold. So these other expenses could include, if you conduct a business out of your house, maybe it's home internet. Maybe you have other maintenance expenses. Obviously this is, again, a case-by-case basis. We'll also ask if COVID-19 has affected your business. With dealing with 24 months bank statements, sometimes we still see lingering businesses that were affected by COVID, but not too much so anymore. And then our final question on the SEQ would ask, is there anything else you'd like to tell us as we review your bank statements? So after our analysts have reviewed, the self-employed questionnaire, we'd be looking at determining our expense factor. And now, once we try to understand a business's expense structure, we'd go ahead and input a percentage. So when we do that, we're trying to determine revenue versus income. So what we get from this bank statements are, gross revenue from a company. And so this gross revenue can include wire transfers, e-deposits, ATM deposits, and obviously is individual to the nature of the business. And so when we get this gross revenue, our expense factor is virtually turning these gross revenue figures into net income. So we determine and sort through all of the deposits that are, being conducted via the business, and we determine which of the following would be, income and which wouldn't. So for example, in a construction company, you're going to see a lot of wire transfers. And so some of these wire transfers would be, sale from an escrow or title company, and others may be draws. So what money coming into a construction company paying for, their construction costs up front. And now those are both deposits, but those are not both income figures. And so we're really sorting through each deposit and determining what is income for the business. And then by applying our expense factor, we're determining what bottom line is their net income to give them a monthly net income figure. So as Christian said before, sometimes we have multiple sets of bank statements. Sometimes we have multiple businesses where, the borrower may own certain different percentages, and we treat this again completely differently and, evaluate each one. And that may require, your account executive coming back to you, asking some questions about the nature of the business that you would have to relate to the borrower, so we can get, our pre-underwrite done up front. And now something somewhat new to LendSure is our automation and enabling our analysis to be done in less than an hour. Now, if you submit, your big banks, so your Chase Bank, your US Bank, Bank of America bank statements, we utilize a software called Prudent AI. And what Prudent AI does is dissect the actual bank statements into something that we can read. So rather than spending time, plugging in and inputting all of these metrics by hand, we can actually, put it into our AI software, and it'll spit out a easy to read metric for us to look at and determine what are your net deposits. We can look at all of your withdrawals to help determine an expense factor along with the self-employed questionnaire that I walked through. And after looking at all those things and asking the right questions to determine, how that borrower runs his or her individual business, we would come to an expense factor to give us a monthly income. So that's around how we would evaluate a bank statement income. Next slide, please, Rose.
Sure.
I'd like to add on to that as well, just to give some additional information on the Prudent stuff. Prudent is amazing. We used to have to do these hand by hand, like Andrew said, and it took forever. So it saved us a ton of time. Most of them are done within 20 to 40 minutes. If the bank statements are coming from a small credit union in some local town, those still can take a little bit longer because the AI software is not used to managing, viewing those types of bank statements, as they'll be different than your Bank of America, stuff like that. But majority of the bank statements that we get can be done in 30 to 45 minutes. We get you a quick, income calc. It's just smaller credit unions might take a bit longer.
Yes, so what we look for, particularly in the bank statements, and I'll bridge off of what Jordan said, is we will use our Prudent AI to look at the deposits. So rather than, opening each bank statement one at a time, we have this nice metric that shows us, what are we looking at every month? Are these deposits consistent? Is each transaction consistent? Meaning, are you depositing via ATM withdrawals or ATM deposits every month? Are you getting wire transfers every month? Are you an Uber driver and you're getting Stripe income every month? Do you own a restaurant? Are you getting Square? Do you use Square as your credit card service? Are you getting Square deposits every month? So this allows us to really dive deep into not only the nature of the business, but how income is generated from each of these, different income streams. So, you'll see your hybrid, and, we have a lot of borrowers who may get Venmo payments, whether it be, for your restaurant, or if you're a property manager and, your tenants are paying you via Venmo. We can see that in the bank statements as well, to determine, are these deposits consistent? Are you getting this truly each and every month? like we said before, we're trying to determine what percentage of the business the borrower owns. If it's 100%, then our expense factor, you would divide our total monthly income, multiply it by 100%, which of course would be the same, and then multiply it yet again by the expense factor to get our monthly income. So as an analyst, we would go and look at, the business entity online. So if it's California, we would look up California business entity search and look up that LLC, pull up the original articles filing and see, what the ownership percentage is. But we'd also lean on what the borrower inputs onto their SEQ as well. When looking at withdrawals, we would also base our withdrawal calculation based on, what does the prudent spread look like to us? And so for me as an analyst in prudent, I can see, every single withdrawal sorted to me for every single bank statement. So, personally, I would sort it into, by withdrawal type. So I can see, yes, they are paying this every month. Yes, this is a tax payment every month. Yes, this is payroll every month. And so we would also look and see if the borrower is paying for personal items from the business account. So this isn't an uncommon thing to see either. So, we're not going to count the borrower's, we'll call them life expenses against them, their trips to the grocery store, them filling up gas, them paying their utility electric bills. If that's not a business expense, then, we've sorted through that and we obviously will not count it against them. So we're purely not taking gross deposits divided by gross withdrawals to get our expense factor. We're really diving into how the business is conducted. Like we said, we'll see how much overhead we have and how the business is trending. Christian mentioned this earlier, we do ask for 24 months bank statement, but if the business has had a subtle or even a decline year over year, then, we may eliminate 12 of those months and take the most recent 12 months bank statements to qualify. And now doing that would mean you lose your, incentive for 24 months, but in reality, it would most likely give you more income, which is why we would do that. We look for how long the borrower has been in the business. For our guidelines, we require 2 years self-employment. So if the borrower has not been self-employed for 2 years, that does not mean that we won't do the deal. Like we said before, we're a common sense lender, and a lot of times you'll have borrowers switching from W-2 to 1099, and they'll still have the same relevant industry experience, but they may be new to the self-employed business ownership. So we want to see how long the borrower's been in business. And, when we get 24 months and we see the borrower's been doing it for, 30 years, maybe it's a family business, that also has a lot of weight in how we make our decisions. We look at if the account has overdrafts or non-sufficient funds. Now this, again, is on a case-by-case basis because I'm sure some of you are thinking that, if you have an overdraft or maybe non-sufficient funds, that would mean your expense factor is going to be very high. A lot of times, that may not be the case because if the borrower truly has an account dedicated to their own personal business, you often see transfers out to maybe a checking account or a personal savings account. So the borrower doesn't like to run their personal business bank statement with a ton of extra money in it, so they can go put it in a high yield savings account, whatever the case may be. So we would for sure ask, our prudent AI software would flag that we do have overdraft or NSFs. So those would be something we'd ask the borrower about and of course handle on a case-by-case basis. We'd also look lastly if the address on the bank statement matches the IRLA. So when we get the IRLA, we're looking at the borrower's primary address. We're also looking at the SEQ where the borrower does conduct business. So when we see, where the bank statements are addressed to, we would hope that it would align to where the borrower is conducting business, or simply be something like a PO box where they're able to send their income. So after all of those things are aligned, this is what us underwriters are looking at. We're also deciphering, what is our credit score? What is the FICO of the borrower that we're trying to qualify here? What is the history of the payments that they've made? Have they handled a similar mortgage balance before? Do they have proof, or have they shown via their history that they can handle such payment? And also LTV. So we'll look at what the borrowers are willing to put down. So we would obviously look under more of a microscope if we're at 90% LTV with a lower FICO than we would if a borrower is willing to put 30% down and be at say 70 LTV. That just goes to show their skin in the game. and their commitment towards making that mortgage payment and their thought process behind putting that much down. So those are also things as an underwriting standpoint that we would consider.
Okay, I've got a couple of different people asking about whether they're going to get a copy of the slide deck. Yes, look for an email from me about an hour after the webinar. It's going to include a link to the webinar recording, and it's also going to include a link to the slide deck, as well as a link to the marketing resources that I talked about earlier. And I've also got a couple of questions about where to find the self-employment questionnaire. That's posted on LendSure.com. Just go to LendSure.com. Go under broker resources, and from there you're going to see it in the forms section. You'll see the self-employment questionnaire.
Thanks, Rose. All right, now talking about the expense ratio, just because this term was thrown around a lot. So this is for people that are newer to the bank statement loans. The expense ratio, this is the number that we're using to determine what percentage of the deposits we can actually count as income, with which Andrew described a lot. But just a quick example with easy numbers. So if the borrower is averaging $10,000 in monthly deposits and their expenses each month are around $2,500, that would come out to a 25% expense ratio, meaning that their actual income that we get to use to qualify is $7,500. So if we get you, a bank statement calculation done with you send us 12 or 24 month statements, and we have 50,000 monthly income, and we send that back to you. We're our average is 50,000 per month. That's before expenses are taken into account if we don't have our self-employment questionnaire completed yet. So it's one thing to keep in mind. We do still have to apply the expenses for the business to run and deduct that from the monthly averages. But go ahead and hit the next slide, Rose. All right, now getting into some specific examples that we've come across. Some of them are super recent. The restaurant owner. So a borrower that owns 5 different Subway locations with 5 separate bank accounts for each location. We can use multiple bank accounts. Each of these different locations is going to have a different expense ratio. I'm sure they might have a different number of employees or different amount of cost of goods sold each month, different rent amounts for each building space or mortgage if they own it. So it's very important to get separate self-employment questionnaires completed for each account that we're using to qualify. Getting some background feedback from somebody.
Sorry.
No worries. And go ahead and hit the next slide, Rose.
All right, another scenario for you, the doctor. So a physician's office uses one bank account for insurance company reimbursements and another account for payments made directly by patients. And a practice with multiple locations likely has multiple bank statements. So again, this goes back to the fact that we can use multiple bank accounts. The one thing I do want to highlight here, going back to something Andrew said, when we look at the deposits that we're going to ultimately qualify for our final income, again, keep in mind that we're looking for deposit sources that are from the direct income source. So a lot of times we'll see businesses like a doctor's office that have an operating account and a business account, right? And in one of the accounts, we'll see tons and tons of consistent deposits, but we'll see that they're categorized as transfers from a separate account. And so to make things as easy as possible, I mean, again, this is something that you can discuss over the phone prior with your assigned account executive, but ultimately we want to get the account that has the direct income source, okay? If you're not sure, then by all means, send us over, all 3 accounts or, both accounts, whatever it is, and we'll figure it out for you. But main thing there is, again, we want the accounts that are getting the direct income source. In this case, with this specific scenario, we would use both accounts as we're getting the payments from the insurance company as well as the payments made directly by the patients. And then to Jordan's point, again, a practice with multiple locations. We will request multiple, or I should say, a separate SEQ, self-employment questionnaire for each business, just because, again, employee count, payroll costs are going to vary. Cost of goods sold, the materials, or whatever they have is going to vary. So bottom line is, again, with our mantra of being a common sense lender, we want to make sure that we're giving the fair expense factor for that given business or for that given location. Next slide.
Yep, and then this one, the construction company, this was actually a recent one that I went through. So there was 2 separate bank accounts for the business. One was used to pay the day-to-day expenses and receive weekly transfers from the second account. The second account, account number 2, was the one that collected all of the income, but had, the only withdrawals were transfers going out of this account into account number 1. The broker only supplied us with the first bank account. So all we saw was this account that was paying, tons of money coming out in expenses. And the only income being deposited was transfers from some other account that we didn't know what it was. So on paper, it looked like, we had no income there at all. But based on the credit, the 1003 and all the bills and, things this borrower was able to afford, there had to be more money there. So we figured out that something was missing. So it's very important to, take a quick peek at the bank statements. We don't want you guys to go and do a calculation and, oh, here's what he's averaging each month. Here, I broke it down for you. We'll take care of all that. We just want you guys to understand, where's the money coming from, making sure that's super clear in the self-employment questionnaire so we understand how your borrowers are running their business. That makes our jobs a lot easier. It helps us, make sure we can give them the most income possible the more we know about their business. So, filling out a complete self-employment questionnaire, reviewing the bank statements quickly before you send them over to us is super helpful in making sure that we can, put the best foot forward and get the most income possible.
Okay. Gina wants to know if this program is offered to ITIN buyers.
It is. Yep. We do allow bank statements on our ITIN program.
Cool.
All right, as Christian has mentioned previously, we do hybrid income, and these are a couple examples of scenarios we've gotten and deals we've funded as well. So a wage earner with a self-employed side gig, classic example of that would be somebody earning a W-2 wage and doing Uber on the side. And now we would get your bank statements, and like I said before, we would see Stripe. Stripe is predominantly how Uber drivers are paid. So on the bank statements, you would obviously see how the borrower is also paid via their W-2 job. So we would do the due diligence there, take their normal income from their W-2, but in the bank statements, we would only include Uber income. So, other self-employed jobs, same thing. Once we determine how they make the money, we're not going to double count, the W-2 job. Also self-employed borrower with a W-2 spouse. So, these are borrowers that may need just a little extra income, but are still most likely A-paper borrowers. But they're buying a house and they need just a little bit more in income to get their DTI in line. We do that as well. It's very similar to the example above, but instead of the borrower doing 2 jobs, just the spouse doing one of the 2. Multiple employment gigs. So if they deliver for Amazon and drive Uber, again, we're going to take a deep dive into the income stream. We're going to ask, how are you paid via Amazon? And a lot of times in this example, you would see strict Amazon payments, and for Uber, you'd see Stripe payments, so it's pretty easy. But again, we would lean heavily on the SEQ and our outcome or our output from our Prudent AI software to decipher, which income is which. Asset depletion, in addition to bank statement income or W-2 income. So a lot of times you'll, again, have A-paper borrowers making, a significant amount of money W-2, but, they're smart investors, especially in this market, and they prefer to keep a lot of their capital, invested in the market, which is how you would utilize our asset depletion program. So a borrower who, could potentially put, 50, 60, be at 50, 60% LTV would maybe want to hold back and stay at 80 and keep, their retirement fund intact, keep their stocks and bonds invested in the market. So although they may not, be able to go Fannie Freddie with just that W-2 wage, we would take their total assets and apply a use percentage. So on that, anything liquid, we'd give 100% of its value. Any stocks and bonds, we would give 80% of its value due to having to pay capital gains tax and potential volatility in the market. And we would give a 70% use percentage to retirement funds. Although they are comprised of stocks and bonds, the extra 10% is made from a penalty to take out of your retirement fund early. So after totaling your assets and providing our use percentage, we would back out the down payment and closing costs, and your total income, we would divide by 120 in terms of asset depletion to give you a monthly income amount just based off of your assets alone. So in addition to a W-2 income, we often see a substantial increase in monthly income for a borrower that way. The last example would be a W-2 server that also receives tips. So this is a classic one. A lot of borrowers in Las Vegas may have this income stream. maybe, you know, like a bartender or somebody that works at a casino. So we would take, you know, line 3 of your W-2, which excludes tip income. So that's just your base pay from your employer. And we would also collect, whether it be 12 or 24 months bank statements, and, you know, include all cash deposits, which your cash deposits would be your tip income. So that's a nice combination of, you know, not only your W-2 base pay, but also the tips you receive, because as Christian said earlier, you know, a borrower who's getting tips is not going to report everything that they've gotten to the IRS. So we'd be able to show more income than a tax return would.
Andrew, Alfred wants to know, would you use 100% of Uber/Lyft income, or do you expense that out too?
So potentially, and based on our experience and industry experience, the average Uber driver would have a 15 to possibly 20% expense factor. If they own their car, and, you know, a lot of times we would have either rent payments or lease payments for a car, that would be input into your expense factor, because that is technically your line of work. So you're paying for an automobile to drive. But if you owned your car, you'd still be paying insurance. You would still be paying for maintenance on your car, so, you know, replacing the tires, fueling it up, cleaning it out, you know, having to go, you know, get a car wash every week. So there's still potential, you know, expenses with Uber and Lyft. So I would say 15% would be about where we're at, without, you know, seeing any other specifics.
Okay, just kind of recap a little bit some of the things that, again, set us apart. We do not require third-party prepared P&Ls to verify the expense factor. Again, we put that in the hands of you and your borrower. Tell us about your business. Tell us about the expenses, right? In our opinion, nobody knows the business better than the owner. And again, it's just one less thing that we have to wait on from a third party. Minimum expense factor is 10%. So again, we will be flexible based on the business, but this has been huge, especially with those realtors that we work with, you know, Uber drivers of the world, you know, businesses that have very limited expenses. We're able to maximize their income and qualify a lot of the borrowers. So again, that's a very big perk of moving forward with LendSure there. We will go up to 90% LTV with 24 months bank statements on primary residence transactions. We can also, again, use bank statements on any other occupancy type. We will hedge back our risk on the LTV for a second home or investment, but 90 LTV is allowed with 24 months bank statements and 740 FICO minimum. We do not require borrower owns 100% of the business. We provided some examples of that. We can get very flexible, use multiple accounts. And again, especially as you're getting started in your non-QM pipeline and starting to explore into the bank statement route, if you want to, you know, just kind of dip your feet in and you have a potential borrower, before getting a full file, before pulling credit, send us over the bank statements. We'll walk you through the SEQ. We'll give you what the final income looks like before we move forward, so we can see, you know, what we're working with. Does this income figure, you know, potentially work for, you know, the home the borrower is trying to purchase, or, you know, potentially refi, whatever it is. And then, as Andrew said, we are a common sense lender. We will work with NSFs and overdrafts depending on the situation. Whereas with other lenders, that can be a hard stop. So again, I think in general, one of the best parts about LendSure is that we do make a lot of common sense exceptions based on that circumstance.
Yep. Just to build off that, can you go back one more slide, Rose, real quick?
Sure.
Appreciate it. Just to build a little bit off what Christian was saying. For those of you that haven't done a bunch of bank statement loans, our competitors typically will cut the deposits directly in half. So your Uber drivers or CPAs that work from home, you know, that have the low expenses that should be getting a 10% expense factor, they'll be cut in half directly unless you go to a CPA and have them confirm what the actual expenses are for their business. So just wanted to make sure that that's known for those of you that don't do a ton of bank statements, don't know exactly how these programs work or why that's a benefit to us. Is most of these deposits are going to be, you know, sliced in half with other lenders unless you go get additional documentation.
Perfect. All right. Excited about this one. So the career professional, I'm going to use air quotations, program. This is hands down my favorite loan that we do because, as we were just talking about, here at LendSure, our mantra is we are a common sense lender, right? One thing that is important to know about us that we have not mentioned yet is we do make exceptions on about 40% of our loans. We lead the industry in that aspect by far. Because of that, we came up with this program, and I say program with the air quotations because it's not something that you're actually going to find on a rate sheet. This is a type of borrower that is very unique in each way. Therefore, we take each one on a case-by-case basis. But nonetheless, I can tell you in my tenure here at LendSure in the 4 years I've been here, this is hands down the most common loan that I have funded. So to give you guys just a quick backstory, we work with a broker here in the state of Utah that works very heavily with doctors and physicians and CRNAs. And when we first started working with them, the most common loan scenario or the issue why they were coming to us, the non-QM route, is a lot of these borrowers have been self-employed for less than 1 year, less than 2 years, whatever it is. But when we dove into these loan scenarios, we started to figure out that we're dealing with some very good borrowers here, very, very strong borrowers, good credit, strong assets, and solid income. And when we talk about the income piece, these borrowers that have been self-employed for 3 months, 6 months, a year, whatever it is, they've been in the same line of work previously for 2+ years, sometimes 10 years, right? And so bottom line is these borrowers were switching to the 1099 route simply because there was more of an opportunity to make money. And so we're asking ourselves, and we're going to our president, why would we not lend to this borrower? They're making great money, and all the other aspects I talked about. So with all that and the amount of scenarios that we had, we came up with this de facto program. And so the bottom line is anytime that you guys have a borrower that is less than a year self-employed, the first question you should be asking is Mr. or Mrs. Borrower, have you been in the same line of work for at least 2 years prior? And can we paper trail that? Can we collect previous year's W-2s to be able to prove that you're in the same line of work, right? We'll look at the business, make sure they're doing the same thing. After that, we'll take a look at their tenure in the new 1099 or self-employed role. And the reason that we wanted to segue this into the bank statement conversation is typically the easiest way to illustrate their new year-to-date earnings after starting the self-employment role is by collecting their bank statements. And so this is where we get very creative. If the borrower has been self-employed for 8 months, we're collecting 8 months of bank statements, along with, hopefully a lot of them have contracts. Apologies, my AirPods just died. But we're collecting, hopefully, 1099 work contracts that show guarantees of how much they're making. Again, we'll illustrate that with 8 months of bank statements and average that out to get them qualified. In other cases, we have closer to 24 months. But bottom line is here, again, it's a case-by-case situation. I've seen these types of loans approved as high as 90% LTV when we have guaranteed 1099 salaries. I've seen other deals where we have a dentist who purchased a existing practice 3 months ago, and we approved that one at 70% LTV. We collected the previous owner's tax returns, showed that the business was doing well before, and we saw that year to date, our borrower has been doing very well and hasn't skipped a beat. So a lot of information here. They're case by case. This is 100% a loan that you should be calling your assigned account executive, talking through the scenario, figuring out how you're going to structure it, and getting the pre-approval submitted so we can see what we can ultimately get approved as far as LTV and pricing goes. But love this program. It's very niche to LendSure and what we do. And again, it speaks to our common sense mentality of trying to do loans for good strong borrowers.
Okay. We've got a question from Trey. He says, question for starting a business from scratch in 10 to 12 months. Would this involve short/mid-term rentals and corporate leasing businesses?
Say that one more time.
Yeah.
Question for starting a business from scratch in 10 to 12 months. Would this involve short/mid-term rentals and corporate leasing businesses?
So I'm not sure if I'm understanding the question completely, but in a situation like this, it sounds like the borrowers had the business for 10 to 12 months, which is great. That's a good chunk of time to where we can collect close to 12 months of bank statements. Again, the first question we'll ask is, was the borrower previously doing this in a W-2 role for some other company, right? Let's check that box first, make sure we're good to go. From there, in this line of work, it sounds like they might have, different agreements or contracts in place with rental companies or buildings, that's where I apologize. I'm a little bit confused about the question. But in the cases where they have agreements in place with partner businesses for a frequent income source, we would actually ask for those contracts to be able to show improved consistency and continuation in income and go from there.
Okay, thank you. And
All right, now just quickly touching on some of the other options that we have at LendSure. I know today was mainly focused on self-employed borrowers and bank statements, but just to give you guys a little bit of insight on what other things we do. So for national loans, cash out loans up to $1 million. We can go higher at lower LTVs. Non-warrantable condos, condotels, 2 to 4 unit properties, 5 to 8 unit properties, second homes, construction takeout loans, fix and flip, our Boost Bridge Loans program, which is extremely popular right now. So if you do not know about that, please contact one of us or your assigned account executive to find out more about that program. Asset depletion and asset qualifier. Those two are basically just what Andrew talked about earlier, using the assets to give us an income for each month. And then interest only loans available up to a 40-year term. So we do have the 10-year interest only available. That transitions into a 30-year fixed after the IO period. And then lease option and land contract loans are treated as refinances, and we do offer 1031 exchanges. And to get more complicated with that, we do have reverse 1031 exchanges we allow as well.
okay, and then Anne, yes, I will be happy to send you details on our construction takeout loans. I'll have one of the account executives reach out to you directly.
Awesome.
Spark.
All right. Last but not least, Spark is our online pricing engine. So before I get into that real fast, 100% recommend, if you haven't already, check out our website. As mentioned earlier, our SEQ, our self-employment questionnaire, is located on there. But also, the bank statement program is only one of the many programs that we offer. And so, like the slide that Jordan just covered, if you're curious about any of the other programs, take a look at our website. We have further information on all of that. But back to the Spark conversation, when you do go to our website, in the top right corner, you will see the Spark pricing engine. This is a great way to get an initial idea if this is something that LendSure can do, if the loan will qualify, as well as our pricing as it is today. Now, I do say an initial idea if the loan will qualify, because I want to make sure that for those of you that do use the Spark pricing engine, if you get the denied reason, I don't want you to give up on the loan just yet. Please reach out to your assigned account executive. I mentioned earlier that we make exceptions on 40% of our loans. And we want to make sure that we're having that discussion with you, and we're making sure before we count out the loan that we've looked at every avenue possible to get this thing qualified. Again, I mentioned earlier that all of our account executives have experience as an underwriter. We'll have very good conversations over the phone to figure out if this is something we can do or not. But again, Spark is a great tool to get an initial idea of something we can do, and also to check out the pricing that we have.
Thanks, Christian. Yeah, just to add to that a little bit, if you guys do have a scenario that has a lot of moving parts, very complicated deal, you can type the basic info into Spark, try to get an idea of what the terms will be, but it's definitely better to contact an account executive, discuss it, the ins and outs of the deal, what makes it harder to qualify, or that kind of thing. If you have your cookie cutter guy owns construction company, income's great, credit's great, that's the best way to utilize Spark is to find out exactly what our terms are going to be there.
Okay. Gina wants to know to whom do we email bank statement for a preliminary review? Gina, go ahead and reach out to me. You can click reply on the thank you email that I'm going to send in about an hour. And what I will do is connect you with a account executive in your area. And Albert wants to know, can I price out DSCRs and fix and flips as well on Spark?
DSCR you can. Fix and flip does follow a bit of a different process. If you go to LendSure.com, under the loan programs tab, you'll see a fix and flip link. And we have a designated fix and flip team of a few people that's all they do. That's their specialty. That's all they work on. They're in direct contact with our fix and flip investor. You type in the details of the transaction to them. They're really quick with it most of the time. Usually within 24 hours, they'll have an idea of what the terms are going to be, if they like the deal, if they can do it, or reach out with additional questions. So for fix and flip specifically, You can chat with your account executive about it, but it does truly start on our website with that one. You submit what we call the term sheet that pings the fix and flip team, and then they'll start, underwriting quickly your scenario.
Sergio, I hope that answers your question about what are the requirements for fix and flip. And what's the minimum loan amount that we finance?
On paper, it is 150K. Anything under 175 does have some additional pricing to make sure we don't lose money on the loan. But I have seen us go as low as 120, 125 before with some compensating factors of a super clean, easy loan. But typically it's around 150K is the minimum.
Okay. Now, the marketing resources, look for an email from me with a thank you, that's going to have the slide deck, it's going to have the link to the recording, and it's going to have this handy dandy thing. This resource kit contains, this one right here is the marketing resources, ton of marketing things for bank statement program, in addition to other programs. But you'll also receive links to this handy dandy white paper, a bunch of Scotsman articles that we have written, and infographics and more. So please check it out. That is our gift to you for attending today's webinar. With that, please go ahead and ask any additional questions that you may have about our program. Trey says, if they have several, he's the one that asked the question earlier about midterm rentals. He says, if they have several business accounts for each property being used as a short-term or midterm rental and corporate leasing, would these bank accounts be able to be used in order to qualify them if they started the business less than a year ago? Would this fall under starting a business from scratch?
Yeah, so to answer the first part of the question, we would collect the 10 or 12 months of bank statements for the short-term rentals. Now, keep in mind that with short-term rents, there is a bit more risk associated with that compared to long-term rents. We do allow for it, but ultimately, I think how we would qualify for this is we would take the 10 or 11 months, however many months of bank statements they have, and we'd probably ratio that over 12 months to have a conservative income figure, okay? As far as the business starting from scratch, it sounds like there's the possibility that this borrower has owned these properties for a while. Maybe they just vested them in an LLC. If that's the case, and we have history of them owning these properties, and maybe the short-term rents were going into a personal account prior, then we would ask for the personal statements as well too to get a longer history. Now, if they just started this business and they just acquired these properties and started these short-term rents 10, 11 months ago, that does become a bit tougher. I won't say no, depending on the other factors in the file. How strong is their credit? How strong is their history as an investor? How strong do assets look? So on and so forth. We can build a case for the file, but it would be better if the borrower has owned these properties prior to the 12 months, and then just again, open an LLC and invest these for business purposes. But that's a great scenario, and so I would recommend to whoever asked that question to reach out to Rose, and again, she'll connect you with the account executive located in your area. That's a good one.
Okay, great. Lisa, yes, this is being recorded, and look for an email from me, Rose Waldy, in about an hour. That's going to have a link to the recording, as well as the slide deck, as well as the marketing resource kit. Albert wants to know, can you finance ITIN borrowers?
Yes, we can. We do have an ITIN program, and bank statements are allowed on our ITIN program as well.
Okay. And I think that is all that we have for today's questions. With that, I want to say thank you to our speakers today for joining us today. Any parting words, Christian?
Just thank you for attending. Again, I think one of the things that we really pride ourselves here at LendSure is being very good at communicating. So please give us a call, shoot us an email. We'd love to talk about your loan scenarios and see what we can make work. We do a lot of creative things, and so I would highly recommend building a relationship with your assigned account executive, and seeing if we can start to build a pipeline together. So again, thank you for attending, and good luck.
Awesome. Jordan?
Same. Thanks for attending. It was great being with you guys and speaking. Like Christian said, we do a lot of the heavy lifting on our loans up front. So if you need quick answers, quick income calcs, or just to know if we can do a loan, we'll find out in the first couple of days. You're not going to throw a loan into underwriting with LendSure and wait a week or two and say, oh, sorry, we can't do it. We get those hard questions taken care of up front, and we make sure we can commit to a loan with a pre-approval. So when you get a signed pre-approval from us, you can have some confidence that we're going to get the loan closed unless something crazy happens in the back end.
Awesome. Andrew?
They about said it all. Thank you all for joining. And, I guess my parting words would be to remember that we're a common sense lender and, go off of certain compensating factors like LTV, FICO, and, really gauge on our industry experience to help you guys find a home for your loans.
All right. Thank you so much, everyone. Have a great one.
Thanks, everyone.